Oh, hi folks, it's Julian McCree and welcome to another episode of the Trader Cafe. Well, tonight we are going to be doing a macro markets overview. And um, I'll just get I'll get a camera on in just 1 minute, but don't worry too much about that because we're going to go straight to slides, guys. So I think the key thing for us is being able to have a look at the markets and what is going on at the moment. So let me share my screen and we'll get straight into it. I think, as always, we put a disclaimer up. You know, trading is not for everybody, and please, as always, just look after yourself and be careful when it comes to trading. So what we're going to do today, in terms of the action plan, we're going to look at the markets. Different markets are in different phases at the moment. We're going to look at the different markets, most notably concentrating on the Super 7. And what we're going to do is to first off just really thematically revise the sentiment cycle and what that's going to look like going forward. And really, different markets are in different phases of the sentiment cycle at the moment. And what we need to do is to ensure that we've got a feel, if you like, for where we are in terms of those different markets. So I'm going to do the Super 7, and we will go through those just after we have a look at the sentiment cycle in theory. So why don't we kick off with that? Now, hopefully everybody can see the disclaimer on the screen, and what we're going to do now is I just move the slides on. So as always, what I like to try and do is to illustrate where this fits in my scheme of things. So as a trader, I have three major elements to what I do. The first one is market selection. And this is really where the sentiment cycle comes in. So it's like trying to select the markets that are, if you like, hot for your trading methodology. The second element of it is to make sure we get the timing right of any trade. So we're basically trying to get the moment when we think that we've got the opportunity and the risk reward right to be able to take a trade. And that's a pretty quantitative thing. There's no real reason why that isn't just a fire and forget activity for traders. And then thirdly, we're going to we look at the money management. And what I mean by that is both trade management, so how you use stops, how you use trailing stops, how you think about targets, and secondly, money management as well too in terms of the account. So that means how do you manage your account growth and how do you think about that? Now, there's elements of that I think are really important, and I think it is the majority of the work that traders should be looking at from the in terms of where they want to focus their efforts. So for me, I think really what we are going to do today is we're going to look at that market selection as being the first and most important part of learning, if you like, as a trader. So let's kick it off by really looking at one section of that market selection. So how do you get that this market is hot for me? Well, what I'm going to do today is to look at the sentiment cycle, right? This was first identified by Justin Mamis back in 1991. He wrote a book called The Nature of Risk. You can look it up online at Amazon. I don't think there are any copies left, but you can look at what the book and some of these chapters look like around the sentiment cycle and maybe go and explore that a little bit if you want to learn more about it. But we're going to cover the broad details today. And again, within the sentiment cycle, there's two key times when as a trend trader you should be active and two key times as a range trader that you should be active. And we'll go through some of the particular points in the sentiment cycle that I think are incredibly important, and then how it relates to the current markets a little bit later on. What's really important here is this gives you a feel for where you are, if you like, in the overall cycle. And that's the most important thing. Okay, so let's kick this off. Just hold on 2 seconds, see if I can start my video. Okay, great. I hope you guys can see me there. I should be in the corner of the screen Hopefully you can see these. So let's go to the next slide. So when we look at the sentiment cycle overall, what it does is it takes the market from signs of tremendous optimism and over enthusiasm all the way through to complete discouragement and I'm going to use a word like fed upness, right? Okay, really don't want to be involved in the market and there's no reason why I should ever trade this ever again, if you like. So markets, as always, trade in a relatively psychotic manner, and they never seem to have an equilibrium point where they're just sort of happy or neutral. They're always swinging from over exuberance through to deep depression. Okay, so what we need to do as traders is to identify where those markets are in the cycle, and when we can do that, that gives us a real edge in terms of understanding how our trading methodologies are going to pan out and how we're going to use them to make money out of the markets. So as we look around the landscape today, we can see the different changes that are going through in the marketplace at the moment. So some markets are different points in the sentiment cycle. That's why it's so cool and so interesting right now to feel what's going on. I think if you'd have rolled this back 6 or 8 months ago, it would be easy to say that everybody, almost every single market around the world, would be in some kind of enthusiastic or overconfident phase. Okay, so now when we look at it, there seems to be separation in quite a few places. You know, for those of you that have been following the NASDAQ and the second line stocks on the NASDAQ, you know that they've been trading incredibly poorly, and really what's been holding the NASDAQ up until recently has been those major trillion-dollar stocks like Amazon and Google and Tesla, you know, the FANG stocks, right? And or Mang stocks, I guess, because we should call them now, because Facebook has changed its name. But that because of the cap weighting of that index, you can automatically see how what's gone on is underneath that there's been a significant rotation. What we'll do is we're going to have a look at that a bit later on and see whether there's an opportunity coming our way there, because really what's been happening is within this there's opportunities abounding, and that's the key thing. Other markets are at different starts of the cycles, at different phases of the cycle. So right now, okay, let's go through these the different elements of this. This is the cycle as you see it. So you can see the overconfidence and enthusiastic bit. You can see the deep depression bit, and then you can see the journey. And trying to find an equilibrium point in here is actually quite difficult, isn't it? When you look through it, you go, oh yeah, okay, this was a range trade, and this down here was a range trade. But realistically, the trying to find an equilibrium point doesn't really happen. So the market is always swinging from that over exuberance into deep depression. Now, what I've done here is I've overlaid the S&P from, this is a little while ago, from 98 through to about 02, 03. And you can see I'll just flick back and forth between the two of them. You can see this almost matches identical to the way that Justin Mammos in 1991 said the sentiment cycle would play out. The key thing for me is when it comes to stocks, you identify the 3 key downward legs. Okay, so 1, 2, 3, and then the market stabilizes and starts to rally. That, as we will see later on, is going to be very important in terms of identifying what's happening. Now, these are on weekly charts, so this takes time to unfold. This is the big thing that I want to really get across to you. It works across multiple time frames, this methodology, but realistically, when we're taking a step back to try and identify the cycles in terms of news flow, information, what's happening there in the real world, when you're looking at what's going on and the information that you're receiving, probably weekly and daily charts are the best real markers that you're going to have. Short term is quite hard to try and identify, although we will hopefully be able to find a couple that will give us some clues. So let's start with returning confidence. What does this phase mean? This is where the market is, if you like, fully confident about what is going on. Now, the majority of participants, right, are convinced the market is going up, and quite frankly, it's been going up for some time. So if you like, it's a bullish environment. So you can see the retracements, right? Normally are between 3 and 5% when you're thinking about the stock market. But what happens is every single retracement gets bought and the market moves higher. Okay, so there's an underlying confidence that every time the market goes down just a small amount, so 3 to 5%, what happens is everybody bounces back. The market bounces back, people's confidence returns, and we go to a brand new high. Now, we have been seeing that over the course of the last 18 months. Up until about October, November time, we saw that constantly within the NASDAQ cycle. And maybe later on we're going to have a quick look at that just to confirm it. But you get a feel for what's going on. So it's almost like every dip, you just, I'll just buy it again because it's going to go back up. That's the exact dip I've been waiting for. Markets come off a little bit, I'll buy it. Look at that, brand new high. So I'm right. And you do that over and over and over again. And you go, wow, that's actually amazing. And that's what the returning confidence does. People start to feel very cool about what's going on. At some point, right, you will have a dip, and that dip will go down and it will touch the 200-day moving average. That's the major marker for a lot of equity indices. Now, it may be slightly different in different markets. And again, this comes to be part of identifying the cycle. But let's talk about equities. I'll use equities as the example that we're using today. So when we get down to that 200-day moving average, what happens then? The market sort of gets in the region of that and then bounces and bounces aggressively, and then often goes on to new highs. That's called going to the enthusiasm phase. So what people think is that when you get down to 200-day moving average, is this a particular point in time that's really important? Well, no, I know it's just a technical indicator, but the market follows this stuff, right? From there, the prices bounce and they go on to new highs. So that's how you create the enthusiasm point. Now, what's happening at the enthusiasm point is the market is setting brand new highs, having gone up slowly but surely with this grinding pattern of going up and then coming back and going up and coming back. And then it goes down to have the buy the big dip moment and then rallies again. And that last rally is enormous, right? It goes on to brand new highs. So pretty much everybody who ought to be long or who wants to be long or should be getting long has bought the market. So again, thinking about that type of psychosis that you see in the market is bulletproof. People talk about stocks for the long term. They start talking about valuations that are incredible, right? We'll do 50, 60, 70 times earnings. Think of a number, it doesn't matter. Over and over again, you see this mantra repeated where people say, it doesn't matter what earnings are, we just know that this stock's going to go higher. So think about that. Maybe the time when Robinhood was launched as an IPO, which was like about 18 months ago. And again, with things like Tesla, as it went to 1,300 recently. Okay, these are classic examples of this over-enthusiasm point, right? Crazy multiples, but everybody is super bullish. They really genuinely believe that the market is absolutely bulletproof. Every dip should be bought. And more importantly, people's attitudes towards stocks is incredibly positive. So it's that move from the fear of losing money to the fear of missing out. So what happens is your friends are talking about how much money they're making in stocks or NFTs or crypto, or houses, you name it, right? They're out there, especially at the moment. What's going on behind the scenes is that the people who are long who had the positions in those assets from a long time ago are starting to say, well, this is amazing. I can't believe how much money I've made. Right, I'm out. Okay, I'm just going to take my profits. I'm going to walk away. Maybe I'm going to retire early, whatever it is, right? So if you like, the smart money is starting to rotate out of these stocks and start to go flat, thinking that, who knows what's going to happen next, but they've made a lot of money and they're very comfortable. However, for the vast majority of the market, they're moving into that fear of missing out point, right? And you often see it because your friends start telling how much money they're making in different things, right? And you can see those headlines over and over again. So the next stage is when we start to get into the depreciation, if you like, of the market price. So what starts to happen is the market prices start to fall away. Two main elements of that, right? This is where the technical analysis comes in, okay? there is the subtle warning. So if you like, the first initial support level gets broken. Well, hey, you know, support levels have been broken before. Nobody really cares. But you're not quite at the 200-day moving average, but it's a relatively important technical level. And then on top of that, you have the overt warning. That's when the 200-day moving average goes, right? When all of a sudden something has shifted. Can't tell you why, can't tell you when. Again, we're seeing that in some markets has happened recently, and we'll look at some examples of that. But what that causes is the people who bought it during the enthusiasm and the returning confidence phase, now all of a sudden they're not making money. Now they're losing money. And so the fast ones are starting to get out of their positions. The slow ones are saying, oh, it'll come back. But we know that because of this overt warning, that actually we're in that disbelief moment, right? This isn't a buy the big dip time, right? This isn't a confident market, right? This is an overvalued market that's now trying to turn its character from being super enthusiastic, if you like, from a psychosis point of view, being amazing, you know, this is fantastic, all the way starting the journey now to depression. Okay, so when you break that overt warning, you break that technical barrier, when that starts to happen, you sense that something has changed. Okay, now, like I said, people who have stop losses will get triggered early, and they'll get triggered and they get out the market. People who don't run stop losses will start to take some losses. Okay, so you start to get into this, the beginning of the panic phase. So what happens here is the market quickly begins to trade lower. So not 1 or 2 days and then it bounces. We're talking 4, 5, 6 days, 7 days, 8 days in a row, the market trades down and down aggressively. Okay, so that bearish price action takes it through all of the major support levels. You now have a new trend. So trend traders, hands up, trend traders, this is when you need to get excited, okay? Because when you move from that overt warning towards the rest of the journey, okay, this is when you should be short. You should be trading the market from the short side, selling every bounce until proved otherwise. Sometimes there'll be big bounces. Most of the time with this initial phase, there will be no bounces whatsoever, or the initial bounce will be tiny. Right, there's your sign that something is very wrong. Okay, then what happens is we get all the way through the various panic phases when we get into the discouragement and aversion point. Now, I've sort of glossed over this area here. The key thing from a trading perspective is to recognize that you don't have just one move lower, right? You will have either a retest or a significant move that happens usually in 2 to 3 waves. Sometimes in foreign exchange, it only happens in 2 waves. Most of the time in other asset market classes, it happens in 3. So you have the decline, you have a bounce, you have another decline, a bounce, and then a further decline. Literally to the point where people say, I do not want to see this market ever again. So if you think about what's going on here in terms of the psychology and the type of headlines you'll see, this will be the one. The newspapers will pick this up and they'll say stocks are plunging, right? And then about the time they say stocks are plunging, the market will bounce back and everybody goes, phew, that was it. But you know as a trader, that's not true. Now, why do you know as a trader? Because the first dip is not the last dip. Okay, you see the market bounce back, but it doesn't really follow through. It bounces back and then pauses, goes sideways for a while, doesn't really follow through. It tries to break out to the top side, but fails. When you see that failure, the market then starts its second major leg down, beyond the panic phase. Now, this is the point of discouragement. Now, what's happening here is that everybody who hasn't sold now starts to get out. And that's when you hear the things like, I never want to hear about this stock ever again. I never want to trade this market ever again. This is just crazy. So I don't want to be involved. Think back, go back to some of the market times that we've had. The Nikkei is a great example. It spent from 1991 through to the early 2000s going through this phase, right, where it just kept on falling and falling and falling and falling until it went from 41,000 all the way down to 8,000, and then it bottomed and then began to stabilize and then began to rally. And where are we now? We're like 27, 28,000, right? So we're still not back to the old highs that were set in 1991, over 30 years ago. Okay, so when you get to this discouragement point, you can tell from the news headline. This is about the same point in time when the news headlines come out and they say, don't ever invest in this asset class ever again. It's a waste of time. Everybody's lost so much money. Why would you ever go near it? And that's usually the time when you need to get excited. Okay, you need to get excited and go, wow, there's real value here. And if you like, the professionals are looking at the market in terms of trying to choose the value points. They're working out saying, well, this is now so cheap, I cannot lose any money if I hold on to this, right? So they will look at it and go, well, this is almost impossible for me to lose money, so I'll start to purchase, I'll start to nibble away and start to buy things. And you see the maybe 1 or 2 or 3 dips down here. But really this consolidation phase is about the professional traders taking value trades because the market is fundamentally cheap. So if it's a commodity, it will be at or below marginal cost. If it's a stock market, it will be, say, I don't know, 7 or 8 times earnings, something like that, even less than that. 6 times earnings, it pays a good dividend. And if it's foreign exchange, it had a substantial move that is at the point now where the fundamentals have caught up, if you like. So the economy who's been suffering has now started to recover, and you're now beginning to see the shoots of recovery versus and relative to the other side of the foreign exchange trade. So if it's dollar, say dollar CAD, right, the Canadian dollar could at this point be starting to, if you like, come alive because the Canadian economy is beginning to outperform that US economy relative partner. Okay, so very important. And then what happens is you start to climb the wall of worry. Now, what's going on here is if you think about the press will say, well, yeah, but look, yeah, I get it. The market's bounced back a little bit, but nobody cares. Nobody's got any interest in this. Everybody's lost so much money. And realistically, how are you ever going to make money out of this again? And if you think about what's going on, this is the professionals starting to realize that there's opportunities and they're taking the opportunities. It hasn't got to the retail traders yet. Okay, so where do the retail traders get involved? Well, they get involved around the anxiety and aversion point. So what happens at some stage during this initial bounce, right, which may take you back to previous resistance levels? The market goes up there and then it falls again. And then you get the I told you so crowd, right? They go, oh, look, it's come down again. But as it comes down towards the aversion point, what happens is you get a higher low. Okay, a higher low. Now, what I mean by that is to say when you look at the chart pattern, the technical pattern is set up, you get that higher low formation. When you see that, that normally is the sign for an explosive move to the upside. And so here now we are back on trend trading again. So if you like, we've had the downtrend here, we've had the consolidation, we've had the sell-off, and now we're looking for the uptrend. Where does that moment start? It starts at the aversion point. So it's the higher low. Now, you see this pattern repeat itself quite often amongst a number of different market time frames as well as asset markets. On the dailies, it's as clear as a bell when you get it. There was one recently, interestingly enough, in 2 or 3 markets. I think there's some more coming up over the course of the next few months. We're going to see this happening quite a lot. But first off, we have to get through this depression point with a couple of markets. But when you hit this aversion point and it bounces, starts to bounce from here, so I call it a ring low pattern or whatever pattern you want to have down here, the market will explode away to the top side. You will never see these prices again for a very long time. When we get back up to the initial resistance point, there'll be denial that it's happening. Oh, the market will roll over again. Feel that emotional sense of, oh, who cares? It's going to roll over again. But what you'll find happens under the move from the aversion point is the market simply blows straight through those old resistance points and keeps going. And it keeps going an aggressive line straight up. That's why it's so cool for trend traders, because you make money very, very, very quickly, right, compared to normal trades. And so this is brilliant. And then you go through to the point at which you get to the returning confidence phase and the cycle then completes itself and we start all over again. So you can see, guys, with this, right? What we're trying to do with this all the time is we're going, look, the market rotates from supreme confidence through to deep depression back to supreme confidence. How do we identify that and keep looking at that? So when you look at this, here's another example, right? This is the FTSE from 2008. We can see the market trading at the confident level. We have a subtle warning. We then have an overt warning when it breaks a major trend line and a major area. You can either call it via a trend line or you can call it via major support here, and then the panic starts. And then we have the market going down and bouncing up and then going down and bouncing up and then going down for a final hurrah down here in March of 2009 before finally the market makes that bottom. And then you have an initial aversion point trade here and the market recovers. Now, I think actually it went on to go even higher than that, but you can see very quickly from this stage here how fast that move is. You're never going to see those prices again, not for a long time, until the cycle repeats. And then you can see how you go through returning confidence. You then have a little dip, and then you go through enthusiasm, and then you come down to buy the big dip, and then we go off and set new highs in, right? And then maybe we start with subtle warning again. I think the market did go down a little bit, but not forever, right? Here's another example. Okay, this is the S&P 500 from 2008, and you can see again there's major support there. When that breaks, the market comes back to have a look at it, then starts to trade lower. Then you have the panic. It's late 2008, early 2009 again. Then the final, a second leg down, then a final leg down into discouragement. Well, God, the market's horrible. This was back in March. And then look at what's happened. The market rallied, dipped a little. Let's call that the aversion point, and then rallied again aggressively. So that moved from there to there, absolutely enormous. The S&P at the time was 700, guys, 700. Now, 4,400, right? So we've gone a little bit from there. Again, let's look at the DAX index. Here's another example. We have a returning confidence. We have an enthusiasm. There's a buy the big dip. We have an enthusiasm point. We have a subtle warning. We have an overt warning, breaking major supports. Comes back up to that major support line and then just completely rejects it. Down we go. Right, then again, we have the panic phase. Then we have the next bounce. Then we have the discouragement phase, March 2009. And then we start to bounce into the wall of worry. Then we have the aversion point. Boom, and look how aggressively that traded. For almost 2 years, the market traded aggressively higher before yet again it started. And you could argue in the scheme of things, it was a big dip. At this moment in time, you could argue there were some subtle and overt warnings. The market once again had a trade lower before it finally found that higher low there and the higher low here. And then it just shot up, through 2014 into the enthusiasm point. Again, it's at 9,000 with the DAX currently at 15,000 today. So here's some currencies. Now, what's interesting about the way in which currencies work is we have subtle and overt warnings from a technical perspective quite quickly. We then have the big sell-offs. Now, usually you don't get that identifiable 3 waves. You get like 2. Okay, usually you get 2. So you've got to get a big down and then you have a retest and then something changes, right? So the aversion point warning here, right, almost came as a rejection of the next leg down. So the market tried to go down, failed, and then reversed. And wow, did it reverse and reverse back aggressively. Now, all of this took place, if you like, over the period of almost 12 to 15 months. However, so you've got plenty of time. Okay, there's plenty of time to do things here. This is a weekly bar chart. So from a daily perspective, if you unpicked all of this, you'd see the aversion point in down here. Then we come back, then we have a buy the big dip, then we go through to enthusiasm. This is the Aussie dollar up at 108. Amazing. You know where it is now? We're in the 70s, right? And then we started the long decline. This was in 2011. So from 2014, we started the long decline down, back down into the 70s again. So this is really important, this concept of a major bottom forming, right? So you have the initial panic or panic phase, then you have the discouragement, then you have the higher low. And it's that point E that we're all looking for. That is the point at which we should be looking for significant performance to the top side. Let's go and take a couple of examples. Here's the Nikkei 2010. You can see very clearly I've left it in line format, so you can see the big sell-off, the second wave, then the third wave, then the aversion point, and then bang, look how aggressively that traded, right? All the way down to 9,000, and then boom, off it went. It's now at 25. Here's a great example. You can see this down here. This is foreign exchange, sterling Aussie, right? On a 240-minute bar chart, you can see the overall trend is down. We're down cycle there, small rally, then bang, down to a new low. Then it comes up, then we have a higher low, and then boom, look at that. Amazing performance. You want to be long there, right? Look at how much money you can make so quickly. Here's the same thing again. The market is trending down. When it has that higher low, boom, we get that big performance, big aggressive performance to the top side. Dollar Swiss on an hourly chart. Okay. And here we go again. What are we looking at now? This is gold. Okay, so the market is coming down. It has an aversion point here. It starts to bounce. It comes back and then has a second higher low. And then boom, again rallies incredibly fast up to 1800. This was back in 2019, 2020. You know, the market's obviously done not much since then, but you can see how important that trade was. And again, just following through, here's a buy the big dip moment in the Nikkei. So the market came down, had a huge spike low, and then went on to new highs. So that's what we classify as a buy the big dip moment. Harder to trade because you think, oh my God, this market's rolling over and there's something else happening here. But no, it doesn't even break major support, doesn't even get to major support and starts to reverse, right? That's how you know it's a buy the big dip moment. So right, guys, where are we now? Let's go and have a look round at some of the markets. Let me just see if I can... just minimize that, and then I'll pull in a chart from over here. Just hold on 2 seconds and we'll start to go and have a look around. Now what I'm going to do is I'm going to focus on the Super 7. For those of you that aren't sure, okay, we're going to look at the Super 7. Now what are they? So two currency pairs, so Euro US dollar and dollar yen. Okay, why? Because that covers the three main regions of the world. Then we need some commodities in there. Why? Because don't forget, we've got inflation, right? It's hitting us from everywhere. So oil is a key correlation to inflation. That's why we have to follow it. Gold. Why do we follow gold? Because it is a precious metal and a low volatility alternative as a safe haven asset. We follow the S&P 500, the granddaddy of all the stock markets. We have to know wherever this goes, everybody else follows suit. Sometimes they diverge, but the overall direction is absolutely set by the S&P 500. Why do we include the 30-year Treasury bond in here? Well, because the 30-year yield essentially is the market yield for every single thing that's taking place out there today. It's not when the Fed moves interest rates, because they are only really influencing the short term, the 1 month up to 18-month time frame, right? When you talk about long-term interest rates, it's the US Treasury bond, the 30-year yield, that determines what that is. And the Fed has some influence over that, but not a huge amount. And then finally, I'd like to include a cryptocurrency as well too, Ethereum, because it's the benchmark cryptocurrency. We don't use Bitcoin anymore because Bitcoin, as we know, is a little bit difficult over supply and demand. Ethereum is what the market considers to be at the moment the key benchmark for cryptocurrencies. So let's go and have a quick look and see what's happening. So I'm going to start with the stock market. So as you can see, this is a daily chart. Look, over the last 2 to 3 years, the market has been rallying. We all know this, right? Every little mini dip. Bought. How much of an enthusiasm phase do you want? All of a sudden, what's been happening? So let's zoom in on this, right? Let's try and put some trend lines in place here, right? So there we go. There's a major trend line. Oops. And whoop, thank you. And there's another major trend line here. Somewhere in there. Okay, so we got two major trend lines. Which one is this one? Okay, this one is the subtle warning. So we've gone bounce, 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 and then, oh, we've traded through it now. So that's major support, right? Or minor support. This is major support here. So the minute we went below the 4,500 level in the S&P, that was a sign that something new is starting to take place. So in the sentiment cycle, if you think about what's happening, the market has been very enthusiastic, going to brand new highs. And you can see that from the way in which the press has behaved. You know, the stocks are bulletproof, yada, yada, yada. Now, underneath that, okay, underneath those big stocks, we know that underneath that there's been a significant deterioration in the number of stocks trading below their 200-day moving average. There's a lot of internet stocks have done incredibly poorly in the last 6 to 8 months. However, because the majors haven't, and the majors are doing very well, the market has continued to go to new highs. And so what we're seeing now is we're starting to see the majors begin to perform poorly. Now, how do we know? Well, the sloped line is a subtle warning, and the horizontal line is the overt warning. So when you look at this in isolation, you look at it and you go, well, this isn't just getting started now. So when I'm thinking about the sentiment cycle and how this works and how everything fits in with this, then you can say, right, okay, so this is saying to me that it's either one, a buy the big dip moment, so down to the 200-day moving average, and to find that, stick it on. Or what's going on is something new is starting to unfold, right? So we've gone from enthusiasm, and now we're starting to move on the different stages of sentiment cycle all the way through to discouragement. Are we at the discouragement point? I absolutely think not. Okay, so there's plenty of room to go to the downside, so that we're just beginning to get started. Okay. Let's flit around a bit, and I want to pull up, excuse me for a second, I want to pull up Ethereum. Okay, so let's look at what's been going on with Ethereum now. So again, we sort of have, when you pull this market back over a couple of years, you can begin to see the price action. Here was the bounce. Hey guys, look at this one, right? So there's the initial wave, there's the second wave. Let me take this off this and stick it on arrows. Right, so there's the initial wave down. There's the next wave, the discouragement. Then it bounces again, then falls down again to a slightly new low. Right, double bottoms around here, bounces a little bit, half-hearted, and then goes down again. Right, now if you look very carefully, you'll see this low here is higher than these two previous lows. The ring low formation that got put in place here, for those of you that remember, back on the broadcast group, we identified this point, and from here the market began a new rally. And look at the speed of that market rallied. Nothing compared to what had happened before. It just took off all the way from 1800 up to 4,000. What an incredible move. Then we had a buy the big dip. Then it went on from 4,000 to 5,000 in a crazy, crazy, crazy move. Complete enthusiasm. Then we've begun the other side of the cycle. So then we fell down here to major support, and we bounced a little, but then came back down again, then rallied, didn't make the all-time high, interesting, and then in a rush took out all of this major support, stop losses, bounced back quickly, but then started to fall away again. That's the signal. Like, it's not only have we gone through major support and broken it, on the rally we're just not doing what we should do, which is trying to go for new highs. So then the sign is that they're not going to go for new highs, they're going to look for buyers. So where are the buyers? Well, they're not here, they're somewhat below. And then you can see the market beginning to unfold. Here's the initial phases. So we've already had the subtle, this is now the overt warning. Now we're beginning to accelerate. It's wave one. We're in the middle now of wave 3. So a little wave 1 bounce, and then we're going down to wave 3, or if you're Elliott wave, or the second major wave down. This could take us all the way back down to 1800. Who knows where it's going to end up? But what we know at the moment is the market is continuing to trade poorly, and poorly aggressively. Now listen, there'll be bounces, right? We all know that. There will be bounces in this process. But for the time being, it's a seller's market, okay? And so the market continues to fall away. We don't know where it's going to end. We've had wave 1, wave 2. There probably is going to be a third level, which could either be a flat one and it might go sideways, or it could continue to go lower, I don't know, less than 1800. And then the market might start to put in that higher low. That's what we're looking for now. For a real change of trend from here and a re-establishment of the bull trend, we need to see a higher low. That's the key thing, guys. A higher low has to take place. It may be here, it may be down here, it might be even lower. Who knows? And remember, there's some interesting dynamics from market perspective here. Okay, we've gone from 4,800 down to 2,400. We've already half, right? So 50% loss. Okay, so traditionally in crypto land, a 50% loss is normally a big support point. So I wouldn't be surprised the market bounce a little from here, right? However, if it can't hold this, then we're going to head towards the 75% level, which is down to that 1,800 to 1,500 area. That is when life gets interesting, because at 75% you go, well, how much can I really lose with crypto here, right? How much can I really lose? You know, it's down to 75%. What is my real risk? Well, I've got 25% left, if you like. However, you're starting to get real value traders who start to make the play, right? Hopefully. Okay, let's go look at some interest rates, right? So when we look at 30-year bond yields, and this is, if you look at the index on the right-hand side, this is the percentage rate. Now, you can see, just hold on 2 seconds, we're just having a quick chat with some of the bosses. You can see how this market has fallen away, and then we rallied, and then we've fallen away. Now, the question is, where does that higher low take place? And if you look at the overall sentiment cycle, I'm not sure I can see a lot there. Let's see if we can pull the monthly in play. Now, how far can I go back? 1988. For those of you that don't know, you can actually go back even further than this, and the market would be actually higher, near 12 or 13%. Okay, so you've had this constant move lower and lower and lower, cycle lower and cycle lower. So when we look at this movement here, if this is going to reverse, what we need to see here is a, if you like, an aversion point, right? A higher low formation. Now, the question is, we went down here. This is a monthly chart, right? We went down a couple of months ago to new lows of 170. We broke through the bottom of this trading range and then quickly reversed out the top side. That to me is an early warning sign that maybe something else is going on. Maybe this could be an aversion point. So what does this mean? This means that interest rates could well be starting to move higher towards the 3.4% mark, the 30-year interest rates. If that happens, expect more pressure on those stock markets that rely on low interest rates to get the price performance, if you like. So things like those Mang stocks and the major stocks in the market that don't pay a dividend, this is the point in time where you start to worry, right? If interest rates rise, then that correlates usually with a fall in the stock market. So watch very carefully. Where are we wrong? We're wrong if we take out that 167 area for the 30-year. Now, at the moment, that's only 30 or 40 basis points away. Doesn't look like a lot, but it's quite a lot in the scheme of things for bond markets when you look at these are monthly charts we're considering here. But if you look at that pattern, okay, all is not well. Let's go and shorten that time frame up a little bit. Look at a weekly. You can see the dip down, the rejection, and now we're coming up. So I will be buying against this level down here. That's a lot all the time, looking for a trade higher. So we're still looking for a trade higher. Don't know how it's going to unfold. We'll keep watching that. What's happening on the dailies? Let's take it down even further. There's that rejection low. The market rallied, if you like, and you can see almost how you had that move down here, and this was a mini aversion point here, and the market then rallied very quickly. But from here, we have to hold this level here, and if we don't, we're going to go down to here, which we definitely have to hold. That's the 190 area for the 30-year. Otherwise, my idea about it being an aversion point on the monthly charts, all bets are off, right? Okay, let's go look. A couple of more things we've got to look at. Let's go look at dollar yen. So we're looking again at a weekly chart here. Now, what are we seeing? We have seen a rally in dollar yen from about 103 all the way through. Nice big movement. You can see how we've gone sideways, and probably the moving averages has caught up with us on the weeklies. And then we've gone on to a brand new high, and then a brand new high again, and then that finally looked like we've rejected it. And when you go down to the daily chart, what can we see? Right, well, we see this move to a new high, rejection, come back, move to a brand new high. Oh my God, isn't that bulletproof? Doesn't it look like the market's going up forever? But it quickly rejects it and then comes down again. So it seems to suggest to me that for the time being, we may be topping out in dollar yen. We could be looking at lower prices. Don't know where it's going to go. Certainly down to the 200-day moving average, maybe even a little bit lower. to really see if there's a buy the big dip or if there's something else going on. Right now, to me, this appears there's something else going on, given what's happening in the background elsewhere. Okay, let's have a quick look at the euro. This is a slightly different part of the process, right? So this is the weekly chart. You can see we came off a significant decline in the euro. Then we've had a rally back, and then the market's begun to fall away. So you can almost see a different part of the sentiment cycle on the weekly chart here. Here's your move. Here's your enthusiasm point. Here's your bounce to check. That failed. Here's your subtle warning here around this point. Sorry, let me just put the arrow on. The subtle warning here. Maybe I can stick a trend line in. There we go. That's a subtle warning. And here's your overt warning once we broke this. Whoops. There we go. So starting a new leg down in the euro. Now that seems really odd, doesn't it? But if you look at the weekly chart, this pattern doesn't look like it's resolved itself properly. Let's go look at dailies. What are we seeing? So the dailies is a consolidation, but we've tried to go to the top side and failed. So unless we take out this area here at 114, 115, unless we take that out, the market's going to continue to go lower, and I would expect the euro to go lower and the US dollar to rally. Okay, so as we completely unfold into this is leg one down, we're looking for the second leg down before we can think about seeing those higher lows, which will start a new trend in our favor. Right. Lastly, I think we've got two more left. So this is the gold market. This is the gold market on a monthly basis. So what's going on here? So you can see the rally, just gradual rally, and up we go. This is a aversion point. This is an aversion point, I guess, aversion point 2. Market does a huge rally up and then it consolidates. We've really come down to major support and held it. If the market breaks through this 1680 level, absolutely critical, then all bets are off. Until that point, this is unbelievably, guys, for almost 18 months, just a consolidation, and we should be heading off for new highs. Obviously, inflation, there's lots of reasons why the market should go up. Some reasons why it shouldn't, but most of the reasons why we go up, that's the monthly chart. When we go and look at the daily, what's been happening recently, you can see this pattern unfolding. Here's the initial leg down. Here's the aversion point. Look how quickly the market rallied from that point. Then we came back down again to have another big look, and then we rallied again. Then we come back down. We set a higher low and we've rallied again. So this is a market which isn't really accelerating away, but it's putting in higher lows all the time. Look at this, from here, higher low, from here, higher low, from here, higher low. That is a market that's trading with a bullish bias. So until we take out that 1780 right now, take out 1780, all bets are off, right? For the time being on the daily chart, the market looks positive. I know it's trading at the top of the range, but it still continues to look a positive trend. For those of you that follow gold and listen to what Ainsley's commentaries used to be, you will know that this is a seasonal bullish time for gold, right in the middle of this now. And so really from here, this is normally a good time to be owning it, and the market's performing reasonably well. Guys, one last thing, because we're running out of time. As always, we run out of time in these sessions. Here we go. This is the oil market. Now, how about a classic sentiment cycle? We're finishing with the best one. See how you have the enthusiasm, right? And then it doesn't really make it. Then, we start to come down. There's the one. Then we've got the second wave. Then we got the third wave. And we even squeeze in a fourth wave of craziness in oil, down to $60. This, by the way, is a 4-hourly chart, but I just want to illustrate how you can see that sentiment cycle happening. You don't need to look at news headlines. You can spot it on the charts, right? So we get this one first leg, then the second big leg, then the third big leg, then the discouragement leg. Oh my God, who wants to buy oil in the 60s? It's going to the 50s, right? Well, funny enough, it isn't. The market rallies, if you like, bit of denial, then comes down, aversion point, and oh my God, look at that trade after that point. You were never wrong if you bought it down here. Okay, so even on if you go look at the dailies, you can see this pattern unfolding really clearly. Okay, here we go. Guys, here's the initial leg down, there's the aversion point, and bang, we're away. And all we've done recently, the last couple of days, is to realistically just put a correction in place, but there's nothing really special going on. And for those of you that follow some of my methodology, you can spot some of the corrective patterns here 2 or 3 days down. Amazing buy points. Guys, as usual, we've run out of time. I'm really sorry I haven't been able to take questions today, but I hope that's given you some information about what's going on at the moment. See me in TTR in a few minutes' time. I'll be summarizing some of the information about what's happening. Let's highlight this. But as always, think about the sentiment cycle in the round as your market selection, as a way of guiding you about which way to trade. There's nothing wrong with this. We're just seeing it. Now, as always, we never know what's going to happen next, but you go looking for those aversion points. You go looking for the break of the subtle and overt warnings, and you get those two trends, and you can see very quickly how much money you can make, right? Big trade down, aversion point, huge trade up, great opportunity, right? There's lots of models out there that look for these, so copy the models, have a look at the sentiment cycle, absorb it, look for that happening, sometimes on the dailies, sometimes on the weeklies, sometimes on the monthlies, sometimes on the 4 hourlies as we're seeing on this chart. But guys, what a great opportunity, what a great way to trade. And this enables you to increase the risk that you take with your positions, understanding where you are in the sentiment cycle. That's it from me. I hope you've enjoyed my session. As always, guys, thank you very much for listening, and I'll catch you in a couple of weeks' time. Thank you very much, guys. Really appreciate you taking the time to let me go through this for you. Okay, cheers, everybody.